Right now, David, we need an update on what your economists see of the global economy. What is the blue book on a July morning? What does it look like?
We'll be coming out with our update of the World Economic Outlook in a week or so. We still see the global economy as sluggish. Investment's slow and trade growth is particularly slow. You know, trade growth in the world slowed to 1% in the first quarter and 0.5% in April. Usually it grows faster than global GDP. So that's a troubling factor. And I think when you look at the whole picture, one has to be concerned that this sluggish growth needs to be responded to.
Dr. Lipton, this came up yesterday 3 times. I'm going to ask you, and I do this with great respect for your research capabilities. Do you believe the economic data out of China, when they quote us a 6.2 statistic, is that a valid statistic created out of real evidence, or do they make it up as they go?
No, I think there's a basis for it. There are always flaws and shortcomings. We've been providing technical assistance to China for some years to try to improve the quality of their statistics. It's obviously a huge and complex economy. But I think that the data captured the events. They have had much faster growth years ago, and it's been slowing for quite a number of years. And now I think, it's in the low 6s. We expect that it's going to slow gradually, provided that the global economy stays in good shape. It could slow more if the trade and technology tensions intensify.
David, let me help you write one of your appendices for your New World Outlook update. I'll do it with less grace than you will.
Yeah.
And that is, we have a president who borders on mercantilism, a president who is not multilateral. How will you address the linkage of President Trump's trade policy into global slowdown?
First, I think it's important to acknowledge that the discontent about trade and technology that you see in the United States and Europe comes from some real frustrations. And so it is important that the differences of views in the world be sorted out. China has, over the years, had a set of trade practices that weren't terribly consequential when it was a $1 trillion economy in the year 2000, but now is a $13.5 trillion economy. These are consequential. So what we'd like to see is for the trade tensions to be replaced by dialogue and some resolution with some action.
David Lipton, it's Naira in London. Great to have you on the show today. You said a moment ago that sluggish growth... Hi. You said a moment ago that sluggish growth needs to be responded to. Should central banks globally then be cutting rates and resuming quantitative easing?
Well, let me put it this way. First, right now our baseline is for sluggish growth slightly stronger in 2020. Our baseline is not a slowdown to zero, let alone a recession. So the first admonition is, as Christine Lagarde has been saying, is do no harm. It's important that trade tensions and technology tensions not tip the world into recession. And the reason for that, of course, is that we just have fewer tools. Our tools have less policy space than we had at the time of the global financial crisis. Monetary policy has already been expansionary, fiscal policy likewise. So the first rule is do no harm to avoid recession. And then the second is to, I think all policymakers should be responding in a data-driven way to see what comes. The U.S. economy has very low unemployment, and we haven't yet seen any picking up of inflation. The European economy we see as much, and I think the European Commission sees as much slower this year than last. So central banks have to keep an eye on the circumstances in their particular jurisdiction and try to keep their economies on the right trajectory to achieve their objectives. But all need to be ready in case there is a significant slowdown to respond much more forcefully.
In the case of a significant slowdown, David, which part of the world do you expect to provide the biggest downward drag on global growth?
Well, it's hard to say because we don't know what shocks are coming. But I think that Europe is in the situation where the policy tools are somewhat less ready at hand. And clearly, as Mario Draghi has been saying, that it's important that there not be an over-reliance on monetary policy, and that in the event of a downturn, especially a severe downturn, that all policy levers, monetary, fiscal, and structural, be ready to be used.